and welcome to Fintech Insider Insights. I'm David Breer, CEO here at 11FS. In today's episode, we're going to be discussing some new data from S&P Global, which shows that venture capital funding could be on the downturn. This is according to their research based on year-on-year funding in August. Funding is down 37% at its lowest since the COVID pandemic. So what we're going to be doing is discussing this in more detail. We're going to be seeing, is this just a temporary slump, or is this the start of more of a worrying downward trend? What are the implications on fintech, and who, despite these numbers, is actually managing to buck this trend and find investment? To have this discussion with me, I'm joined by some super duper awesome guests. Firstly, Zeynep Yavuz, who is the partner at General Catalysts. This is an investment firm whose portfolio includes Stripe, Canva, and Airbnb. Lovely to have you on the show. How are you doing?
Very good. Thank you for having me.
Very good. And for anybody who doesn't know you and your business, tell us a little bit more about it.
Sure. So as General Catalyst, we're a multi-stage fund. We invest anywhere from pre-seed to growth stage, and we invest globally. I'm focused on helping lead our early stage practice out of London.
Very, very cool. Very well placed to talk about what we're going to be talking about today then, which is lucky. Producers always do an amazing job, don't they? We're also delighted to welcome Kirsty Grant, who is the managing director at equity crowdfunding platform Seedrs. Welcome, Kirsty. How are you doing?
Hi. Thanks for having me, David. I'm well, thank you.
You've had a busy year, I imagine, in these slightly odd times. How goes everything at Seedrs?
We have indeed. I'm trying to think, since the last time I was on 11FS, quite a lot has happened in the life of Seedrs. Late last year, we were acquired by US investment platform Republic. So we're now part of a global team and global investment community, with Seedrs still leading the kind of Republic's offering in the UK and Europe. And speaking of Europe, just last week, we launched our EU regulated platform. This really significant milestone for us, just culmination of about 18 months of work to sort of get authorized and get launched in Europe. So lots to offer both founders and investors now.
It's very exciting times. And again, very well placed to talk about what we're going to be talking about today. And last by no means least, a big FinTech Insider hello to Liza Landsman, who is the CEO over at Stash, who incidentally successfully raised $40 million earlier on this year. So, I mean, you're just sort of proving that this is a big bunch of nonsense and you can do it anyway, I guess, aren't you?
I don't know if that is the lesson I would draw from that, but delighted to talk more about that. Thanks for having me, David.
No problem at all. We'll get into that and much, much more. If we dive straight in then, I guess kicking off and really looking at the state of VC funding, I mean, if fintechs are already feeling a bit of a pinch from the lack of investment, then, I mean, Zeynep, maybe starting with you on this one, this is really what you guys do, looking at with a global view of actually where all of the trends are at and really where different markets are seeing opportunities or rises or falls. I mean, are you seeing a downward turn reflected in the day-to-day of what you're doing?
I wouldn't call it necessarily a downturn. It's definitely an adjustment in response to what's happening at the macro level. So if we look at kind of the last, let's say, 2 to 3 years, we were operating in a low interest rate environment up until COVID, which of course means that the cost of capital is lower, and therefore this fills into public markets, which then hits into private company valuations. And then just before COVID happened, we were already seeing some initial signs of tightening. But then when COVID happened, two things happened. One, the low interest rate environment continued a lot longer than initially it was thought to be. And the second thing is that certain sectors really benefited from to push the digital. And fintech was a big part of this. So as a result, we had a lot of private and kind of public funds going into equities, and also certain sectors really outperforming because of transactional revenue businesses. So if you look at it now with the market tightening, it's the response to that we're seeing a slowdown in funding.
Yeah, I mean, it's an interesting one if you start looking at, I guess, at the size of funding raises and rounds as well, right? We definitely saw The big fintechs were very much putting kind of as much grain in the barn as they could do to weather the winter, weren't they? In terms of not really understanding, when we'd come out of that period. But I mean, are you seeing any impact, though? I guess not just from an investment perspective, but in terms of the period of time that we've been in from COVID. I mean, are there just less startups now? Like, is it harder to begin a business in the middle of a global pandemic than before? I'm not sure I've necessarily seen that, but you could definitely point to why that could be a reason. What do you think?
I mean, I'd say there are more startups, if anything. I think we're seeing the number of late stage funding rounds going down. That's just a response of how much funding has happened in the last 2 years. If you look at particularly the seed stage, we're seeing an absolute boom because it's a really good time to build now from a talent perspective.
Yeah, that's a very good point. I mean, with a lot of people leaving corporate jobs or getting to a point where they feel more comfortable to kind of step out of it. Just on the news last week, we had Jeremy Burge from over in JP Morgan Chase jumping out of that to go and start his own fintech. It's amazing how many people can go and do those things now with all of the right connections. But Kirsty, you were shaking your head there as well. You're not seeing any shortage of startups trying to get into the market or have an impact?
No, I don't think so. I mean, we've certainly seen lower deal volumes this year, but I think that is sort of part of that macro trend that Zeynep's referring to. Out of COVID, we saw a spectacular sort of increase of investment activity, a bunch of businesses launched. As Zeynep was saying, acceleration of adoption of digital solutions for all sorts of things. And so 2021 and bleeding into 2022, we saw incredible activity. But, I think regardless of sort of other macro events going on in the global world at the moment, I don't see how that sort of level of activity and those valuations could have been sustained for much longer. We saw sort of competitive almost deployment of capital through that period. And we just couldn't keep up that pace.
Yeah. Do you think that is actually over, though? And I appreciate the intonation in my voice sort of gave away what I thought on that, because while definitely people are not just throwing money on fintech like it's a disappearing thing, the transformations within slices of financial services are by far over. It feels like the flurry of B2C activity was insane. The retail banks and SME banks, particularly, I think the valuations around those things were a little bit crazy, weren't they? But it feels like the B2B sense of fintech is where more of the money seems to be sort of skewing towards. I don't know, Kirsty, Zeynep, if you're seeing that as well.
Yeah, absolutely. And I wonder whether that's sort of the correction side of things that Zeynep referred to rather than a wholesale shift. Of course, money was flowing into consumer-facing fintechs coming out of COVID. Consumers were spending like crazy. They'd adopted these new technologies. We saw the sort of revenge spending. And, of course, people wanted to be in on that. And as we saw that uptick, there was such a sharp recovery coming out of COVID. Everybody wanted in and everyone was sort of scared of missing out, right? And we're sort of seeing a correction of that where it's back to, okay, what do your unit economics look like rather than just your pure growth rates?
Yeah, I'd say particularly in Europe, it's a special time because if you look at the last 10 years in fintech, a lot of innovation has been in consumer. If you look at the next 10 years, I think the next kind of generation of new fintech unicorns will be built in infrastructure. And that's actually very much driven by talent. Because if we look at Europe now, we're seeing recycling of talent for the first time at scale in fintech. And we're seeing a number of experienced operators who gained their experience operating in these growth consumer fintech businesses, seeing internally how infrastructure scales. And a lot of that they had to build in-house because they didn't have third-party tools. So now they're leaving these roles in the consumer fintechs and they're saying, I'm going to productize this infrastructure. And then we're going to have a new kind of level of new consumer fintechs being built on top of the new infrastructure players that are emerging in Europe. So I think that's an exciting time from like a seed investing perspective, backing these founders and ideas.
I actually love how you're describing the circular economy within the fintech community, but I think that's right.
Yeah, I mean, I think it works both on a talent perspective in terms of people's abilities, but also it works on the almost de-risking it from an investor's perspective as well, right? It's the old sort of jockey horse kind of metaphor, isn't it? I'm sure Zeynep and Kirsty, from an investor perspective, you like to see people who've got a good track record of doing it before, but Liza, from your perspective, bringing in talent who have made these things happen as well is important. Maybe if we stick with you, actually, I mean, you guys have kind of bucked this trend a little bit, bringing in a really sizable raise for Stash. I mean, was that more difficult than previous rounds, or was that more difficult than you think than it just because of the market timing?
Sure. I mean, I only have been in chair at Stash since February. So this is the first round I've raised at Stash, but I've been an operator for multiple decades and took a brief 5-year palate cleanser as a general partner at NEA here in the States. So I have lived through a number of funding environments. I would say this is probably the most difficult of the last 2 decades. But I think, it's interesting. I think there was definitely a pull forward, as both Kirsty and Zeynep have described, in like attraction to consumer fintech during COVID, and a little bit of a reversion to the mean now. But what I would say is that there is a renewed interest in profitable companies with good unit economics, which shouldn't be something that is just about the fashion of the moment, but first principles.
Seems crazy
investing.
when you say it out loud, doesn't it? Really, it's like profitability.
I know.
It'll never catch on.
That's a wacky idea. I know. Who thought of that? But I think part of the reason we were able to attract the capital we did earlier this fall is really because of that. And so it's really structural about the business. I definitely think particularly consumer fintechs will find this environment more challenging than any they would have encountered in the last 5 or 6 years, for sure.
Yeah, it's interesting to. I mean, Zeynep, your point earlier on around, we had a low interest rate. I mean, we had a no interest rate period for like a decade, didn't we? And actually, bizarrely, just that swing change broke a lot of people's spreadsheets that were running their businesses. And if your funding raise was based on a low interest environment, and actually suddenly you've got 5, 6, 7%. It just changes a lot of business models around the world, doesn't it? Which is scary. But I guess on the flip of that, to your point, Kirsty, in terms of seeing new people come wherever there's a most of the greatest fintechs seem to have come out of the financial crisis from 2008 onwards, right? In this crisis, we're definitely seeing people sort of seeing it as an opportunity as much as a threat to everything as well, right?
Yeah, absolutely. And to echo Liza's points, we've been through swings and roundabouts. I mean, Seedrs has been around for 11 years now, and we've been through a number of major world and market events, Brexit, COVID. We've been through, I think, 5 prime ministers in the UK now, political turmoil.
It's just in the last 2 years, isn't it?
Yeah. Yeah, exactly, in the last financial year. And now the latest economic downturn. And our investor base has shown incredible resilience throughout these periods, often out of sync, I'd say, with what is happening in the broader markets. But definitely, I think this one is, I would echo Liza's comments that this is probably the most sustained we've seen, and sort of having the biggest impact on investment into growth stage companies. Why are we out of sync with the markets? I think, firstly, our whole model is predicated on fundraising from a really diverse set of investors. So you can draw on different people at different times. They might have different motivations, different return profiles that they are looking to achieve from your sort of classic VC. And then finally, and this is the same with other venture capital models, it's a long-term illiquid asset class. So we're not always impacted in the same way as the public markets. But we're definitely not immune, and seeing the current downturn, we are seeing the impact. We're just not seeing it as significantly on our investor base as we're seeing elsewhere in venture.
I mean, it seems particularly a sort of a European problem, kind of looking a little bit at the numbers as well. I don't know, Zeynep, if you're kind of looking at that as well, but where we're sort of seeing from a top 10 funding rounds, 6 of them were the US, 4 of them were APAC. Doesn't leave a lot around for a lot of space for Europe. I mean, is that a sign of maybe the maturity of the market potentially, or is it just that there are bigger companies at different stages of the cycle? Is this just an evolutionary hiccup we're having here, and normal service will be resumed as those companies come through?
Yeah, so looking at that list, it's not really apples to apples, because the list includes a lot of kind of pharma, industrial companies that are quite capital intensive. But I think if we were to look at it from a kind of growth and tech innovation perspective, the outcome wouldn't be that different. We're not going to see that many European companies there. If anything, we might see European companies that were originally European and then became US companies. So there is a question of, yes, I think in certain categories, and this is not fintech, so often an enterprise, to build a category defining company and a large enough outcome, you need to be global, and there US is a huge market opportunity. So a lot of European companies go to the US. And from a fintech perspective, we're talking about transactional revenue businesses, and these can get really big in 1 or 2 regions. So, and often they will actually stay in Europe from a regulation perspective because of the way they are built and the customers they target. They can get big enough in Europe, and there's no reason for them to go to the US, except for public markets. That, I think, is going to be a big concern in Europe in the next 10 years. When we think about growth stage, large investments, where do these growth companies and unicorns effectively go public if they are serving customers in Europe? So I think this is something that we'll need to think through, but I don't think it's a market is not big enough question, because for fintech, market is big enough in Europe. It's a question of how do you get exits?
Yeah, I guess in that point on the maturity of the market as well, to a certain degree, right? Actually, if you've got it's been an interesting one over the last, 7 or 8 years, seeing the regulatory frameworks change around the world. Some regions have almost kind of seen the movie before. I know if you look at somebody like Barney over at Clio, they were developing an AI product here. It was very, a sort of competitive market. Going to the US wasn't just about having squillions of people in every state. It was actually like being able to enter the market and be truly competitive in that space as well. So it's interesting that sort of, I know if the Department of International Trade were on the podcast right now, it would be like the import-export model for UK fintech and blah, 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 blah. But it's interesting to see where different regions are doing that really effectively. And actually that regulatory framework that allows fintech to really operate in those spaces. But sorry, Kirsty, I think I cut across you as well.
No, I was just going to say, I do think I completely agree that capital markets in Europe and the UK need improvement to kind of keep, I guess, those more mature companies here at the time of exiting or listing. But I think it's even probably 1 or 2 stages before that, and we are seeing that start to mature over the last few years. But those sort of mega rounds are generally still often involve, being led by US capital, and so I do think there's still some room to grow and mature in terms of the market here. But that, in terms of whether it's a European problem at the moment, part of that, I think, is often just lag. I mean, what we've seen is that we're generally just a little bit behind the US in terms of what the markets do. So, the optimist in me says there's some recovery that we're seeing in the last quarter or so in the US, and hopefully that's coming our way.
Very good. Well, it's always good to leave the first half of a show with a little bit of optimism. The second half of the show, Liza basically has the recipe for sorting this out, right? So we're going to come back and pick her brains a little bit more after the break. All right, see you in a second, folks.
Hello, it's Benjamin here, Director of Research and Strategy at 11FS. Earlier this year, we published Building the Future of Home Buying, a report that calls out financial services for making the biggest, most significant purchase of most people's lives way more difficult than it needs to be. Well, fast forward to today and things haven't changed. Mortgage offerings are more important now than they have ever been, with sky-high interest rates in many countries forcing homebuyers to shop around. We've got clients asking us how to move quickly to fix the problem and get a game-changing product to market. Want to know the secret? Step 1, download the report at 11fs.com/homebuying. Step 2, get in touch at 11fs.com/ventures. Speak soon. Commercial banking is changing faster than many banks can keep pace with. The innovation that's been unleashed by digital technologies and fintechs has transformed what commercial banking looks like today. In our brand new report, in association with Infosys Finacle, we explore the new generation of commercial banking, how value chains are being transformed, and what banks need to do to thrive in this new ecosystem. A must-read report for anyone in commercial banking. We combine our insights with those of 14 thought leaders from across financial services to break down the current situation, the catalysts of change, and what impact it will have on the industry. Don't miss out. Download your copy today at 11fs.com/commercial banking.
All right, welcome back. So in this part of our discussion, what we're going to be doing is taking a little bit of a closer look at those fintechs and finance startups who are actually finding investment in such significantly challenging environment. One example, obviously, Liza, from your perspective with Stash, raising 40 million in this period of time. I mean, it's a difficult thing to do, and many times, and you say you worked in different periods of the market. Tell us a little bit more then. I mean, it's always interesting. I found H1 this year was weird. Nobody was not talking, but actually it felt like the world was just talking. They weren't really sort of doing anything necessarily. So, was it different because there were fewer investors who wanted to have conversations, or were they still talking? Or, I mean, how did the environment feel different?
I think there were a lot of people who were interested in talking. I think that's always going to be true. There's anything that venture capitalists enjoy, it's optionality and knowledge. So, but I think a lot of people waiting to see how public markets will evolve. Kirsty talked about some of the lag between US and Europe. There's certainly a bias in the US to say, like, there's a lag between public and private markets. And so, just as everywhere, people looking for liquidity. And since if you look at what happened in the IPO market in the US in the first half, there were certainly a lot of people who were cautious about whether markets and windows would reopen. I think in our instance, Stash, which is an investing platform for middle-income consumers, was able to differentiate itself in a world where people were particularly cautious about consumer fintechs for all the good reasons that Zeynep and Kirsty have talked about before. Found a foothold, one, because we have a really strong established base of investors, both from the VC community, but also strategics. And I think that diverse investor base was important in the mix. And two, because of our proximity and path to profitability and the strong underlying unit economics. I think there's just been a reversion to first principles view on investing where people actually care about how you will actually make money either now or in the not so distant future. And so I think that's what allowed us to actually get the round done. But it was a slog. I will not joke. Definitely a challenging environment.
Yeah, well, I mean, as you say, it's never it's never easy. Do you know what I mean? Like, nobody's ever just banging on your door with $60 million and going, hey, would you like some of this money? But it's definitely harder in this process, isn't it? The balances and the checks and everything that goes with it. I mean, any market goes through, I guess, there's always the, is it a feature? Is it a product? Is it a business kind of debate, right? So do you think, and again, it sounds such an obvious thing to say out loud, but the sustainability of a long-term product roadmap that shows actually how this is a sustainable business at maturity, I mean, that feels like it shouldn't be something that differentiates in a pitch pack, but actually is at this stage, right?
Yeah, and look, I think we've talked a little bit already about kind of, I will say, the consolidated burst of enthusiasm that occurred during COVID, I think because of the more rapid adoption of some of the digital platforms. But I think that sort of really low interest, close to no interest environment, which made capital abundant and seemingly infinitely available, really created the proliferation of a number of businesses that are really features or products, but not truly platforms or businesses. And I think as we look forward over the next couple of years, particularly in fintech, we're going to see much more consolidation, both within privates and publics and privates, that will kind of, I think, help us recapture some of the value that was, I'm going to say, trapped in the capital deployed inside that bubble.
Yeah. I mean, it's interesting that, this is always never in isolation. When no fintech, no FI is ever in, a lovely little silo. I could probably name a couple of banks who think they are, but I won't name names at this stage. But I think we're seeing big banks acquiring JP Morgan Chase with Nutmeg, or, we're seeing gigantic organizations acquire real advancements from a technological perspective, from a business model perspective, from a brand perspective. When you talk about consolidation, do you think it's really quite far reaching in terms of, obviously we've got this isn't just a fintech versus bank play. There's all of these, Apple acquiring fintechs and all different types of things happening in the mix. Do you think, I guess, the competitive landscape will continue to drive the industry forward as well?
Yeah, look, I think there is a strong desire among consumers, SMB, and enterprise for continued innovation. I think there's a lot of really spectacular talent loose in the market right now, as we talked about before, and I think that's going to drive these continued kind of virtuous circles of innovation in a number of different fronts. I don't think there is a monopoly, so to speak, on banks acquiring fintechs. I do think there was a trend we used to talk about a few years ago, that there's sort of fintech inside of everything, right? And you sort of saw that proliferation, at least on the payment side of the world. And I think that's true now. I think there's a race in the alphabet soup of what letter can you put in front of AS for service, right? Banking as a service, payments as a service, fill in the blank. And the truth is that how you move money around kind of infiltrates almost any aspect of human condition. And so there's almost an infinite number of industries where, the insertion of smart financial tech could be beneficial if it's done strategically. And certainly with the challenge in the fundraising environment today, it creates ample opportunities across a number of sectors for that to occur.
Yeah. We sort of say at 11FS, the industry's only 1% finished. It definitely feels like there's a huge amount of potential. Zeynep, you were talking about that underlying nature of the industry. We talk about the fabric of financial services, that's shifting dramatically. I feel like, Zeynep, this is the bit where I'm going to get your DMs flooded. What do you look for in an investment? I do apologize. You're going to get, don't say Gen AI, whatever you do, because there'll be 1,000 people trying to give you ebooks on LinkedIn as well. But what is it that you guys at General Catalyst are actually looking for?
So for us, and it's also a bit of a personal question, because it's a lot of the partners who also make the investment decision. But I think for everyone at General Catalyst, it's first about the founder. So for us, it doesn't matter what stage we invest in. It needs to be someone who's very passionate about the problem, someone who will endure what's going to be kind of showing up on his way or her way throughout that process, and who has big ambitions to not only create outsized financial returns, but also societal impact. So this is something that we care a lot about. We have a responsible innovation framework. When we invest in companies, or before we invest in companies, we talk about the founder and how the founder fits within the responsible innovation framework, and how does the idea fit within the responsible innovation framework. And within that, we talk about the unintended consequences this company can have on the society, and all the positives that this company can have on the society. And these are really core to how we evaluate companies and make investment decisions. The other thing I'll say is that we have a very thematic approach to investing. And I think this is something relatively new in Europe. We have a lot of US funds who are thematic, and I think now introducing that in Europe. So I primarily focus on enterprise and fintech, and we make all our fintech decisions within our fintech group. So then we're quite thematic in what's going to be the next kind of 10 years what the next 10 years is going to be about from a fintech perspective.
Well, I was going to say, I think that makes a great deal of sense as well. Because, I mean, even in suppressed market, then the people you're investing in want investors who deeply understand the problem that they're trying to solve. Not just from a spreadsheet and financial perspective, but somebody who is as passionate about solving that problem as they are, right? I love the point around I hear all of that as they're like crazily passionate enough to still get up every morning and try and solve that problem, right? Because that's almost determination is like the Liza, I see you sort of nodding along to that one. It's like, running a business is not what people make it out to be. It's not that sort of beautiful entrepreneurial story. It's friggin' hard work. Like, I wouldn't have bothered if somebody told me that beforehand, you know what I mean? But like, actually, it turns out that's like almost like the key thing that goes with it. So, and it's interesting, isn't it? Almost the process that you go through, Liza, to bring in great talent into your organization is really similar to what actually, VCs are looking for in people. It's all about people at the end of the day, isn't it? Success of any business, whether it's a product business or a service business, is all people.
Couldn't agree more. I think I mentioned I was an operator for a couple of decades before I became an investor for a chunk of time and then returned to operating. But when I first became an investor, one of my first investment committees, I thought, oh my God, like, I've never been an investor before. Like, how am I going to frame this? And as we started getting into the discussion, I was like, oh, this is actually just like hiring people. I've been hiring people for 20 years. I totally understand how to do this part. And so, really plus one to what Zeynep said, like the founders make such a huge difference. And I think particularly in these challenging environments, I'm going to butcher it. It's Warren Buffett. It says like you see who's wearing underwear when the water goes out. Maybe it's bathing suit. That makes more sense.
I was going to say a story I can really appreciate having spent a week on the beach. But Kirsty, it's an interesting one, I guess, in this time as well. I mean, one of the big things with fintech is always the community around it. And obviously, that's a big part of what Seedrs really helps facilitate is people being part of the businesses that they really, or being able to invest in the businesses that they really believe in. I mean, has that, do you think, changed in this period of time? Because, I mean, the community, the ecosystem, for want of a better word, around fintech definitely hasn't gone away. The meetups are still as busy as ever. The drive for the community and the fascination for this has not gone away. And that might point to why, with you guys, with Seedrs, that actually there hasn't been a massive change because that desire hasn't gone away.
Absolutely. The appetite is still very much there. Even if we're seeing some bounciness and, even our investors still, looking more at fundamentals of businesses, the appetite to be part of a innovative company that is, delivering a service you want, that dynamic still exists. And that is very much the crux of why fintech's always been such a key part of our portfolio. While we are sector agnostic, fintechs just have a natural affinity for fundraising from their customers and community and creating those strong ties with that community by literally making them shareholders in their company. And those early adopters of fintechs have that natural affinity for transacting online and investing in this new way and in this new model. And that combined, I think, with just us being, headquartered in London, became natural that we were sort of the fundraising platform for many of the UK's fintechs, and particularly that wave of kind of consumer fintechs and neobanks that we talked about earlier. And that, we're seeing that continue. I mean, in H1, I think in the UK, we were still the most active funder of fintechs at seed and Series A stage. But we are seeing significant growth in other areas in terms of pure investment dollars. So while finance and payments remained the top, I think they're still the top spot in H1 in terms of amount raised. Clean energy is actually our fastest growing sector with like a 24% increase in funding in H1. Some of our most successful raises this year have been in that area. And certainly our most recent investor survey, we just asked our investors what they're looking for, and qualitatively the response was sort of matched the numbers in that they're looking very much at clean tech and sort of ESG focused businesses. But I think that just follows that same trend of retail investors wanting part of the decision making, wanting to participate in how capital gets allocated, and which businesses come to the fore and provide solutions for the future.
Yeah. It feels like we probably answered the question pretty effectively. I mean, I don't think the investment in fintech, is done. We're not all out of jobs just yet, thank God, which is good. We've got a few years in this, few more problems to solve, I guess. But I mean, do we really think this will have a lasting impact? This blip, or do we think? Really, I mean, Liza, have you seen over your career? I mean, there's always a sort of a separation of the wheat from the chaff, as it were, in terms of the sustainable businesses and the unsustainable businesses. Is this sort of reckoning actually really healthy for the market in that sense?
I mean, I think it is. I also think, as both Kirsty and Zeynep pointed out, there's really a flurry of, I think, amazing activity at the seed stage right now with new companies being born. I think coming into this post-pandemic period, both because of people from multiple sectors kind of making different choices about how they want to spend their time, I think there's an infusion of both kind of new blood, new thinking, but also experienced, let's call it second and third generation ecosystem participants who have kind of seen problems in, let's call it the Wright brothers phase of the industry, and now want to move us more toward, I'm going to say, modern air travel. We're not quite at the SpaceX level yet.
I agree a little bit with the wheat from the chaff type analogy to an extent, but I do think that can get oversimplified sometimes. I keep having there's a venture capitalist who writes in this area, Tom Tungus, and I keep getting it quoted to me at the moment when people are struggling to raise capital, and he's made all these comments about most startups can run with smaller teams with negligible impact on revenues, and that this is all about focusing back on good executors. I think that is true to an extent, but I do think it can still have an impact on, you can run on a smaller team with negligible impact on revenue in the short term. But we talked earlier about long-term product roadmaps and true innovation. And does that, those are the things that go when you are in a sort of capital constrained environment and you've been told to execute with a smaller team and survive, then it's all about the bets that will pay off, and no one's then in that time willing to make the bet on or push an initiative forward or innovate for something that won't pay off for 6 to 12 months, if at all. So it's all about the proven stuff all of a sudden, and you lose some of that creativity.
Yeah, I mean, it's easier to change direction early than it is trying to change your food source like halfway through, right? That's a very different thing to change your aspirations in that way. I mean, do you think the market has sort of gone a bit of full loop? I know when we did a documentary talking about this, we had Tom Blomfield on there from ex-CEO of Monzo, said, at some point this cycle restarts itself and the challenges start to become challenged by the new people coming through. I think there's an element of those things. We are seeing, yes, people like Monzo and Starling and Nubank and people were really early in this cycle. Nutmeg, actually people kind of progressed to a certain point and then creating that innovation, that continual cycle, the restlessness to keep innovating and keep moving forwards. At some point, that's hard to maintain in organizations, isn't it? And inevitably, that leaves more opportunities on the table to be invested in to pursue that leader in the market.
Yeah, look, I think scale is both a huge advantage, but also can be an inhibitor for change and innovation inside an organization. And that's true regardless of sector, and regardless of whether you're a public or private company. I was going to say earlier to a comment that Kirsty made around like when you sort of really scale down. One of my first bosses, and this was in a large public company, was during a pretty bad crisis in the late 90s. And he looked at me and he said, yeah, but nobody's ever cut their way to growth. And I think it's an important lesson to learn, even when you batten down the hatches to preserve capital, that continued scaling back while it creates creativity, and I think that's important, is not always the way to create the quantum leaps forward from an innovation perspective, whether you're in an enterprise or consumer business.
100%. It goes back to that people point, doesn't it? I mean, I think anybody who says it's easy to downplay, extend your runway is a code word for let people go. And for any organization that's ever been through that, it's not an easy thing to do and maintain the culture of the company and still deliver the things that you want to do. So yeah, I'm with you, Kirsty. I'm not sure that guy might have run a business. Maybe that might be the challenge. All right. On that note, I think we probably better wrap this up because I think the need for money ain't going to go away anytime soon. The opportunities in the fintech space to really make hay in that space are definitely not exhausted in the market. So at that point, we probably should wrap up today's discussion. So thank you so much for everybody for joining us. Where can people learn a little bit more about you and your company? Liza, starting with you.
Follow me on LinkedIn, please.
Very good. Kirsty.
Kirsty Grant on LinkedIn, and you can find us at Seedrs.com.
Very good. Zeynep.
You can also find me on LinkedIn, Zeynep Yavuz, and you can find Journal Catalyst online, journalcatalyst.com.
Very, very good. As for me, you can predominantly find me lurking on LinkedIn these days. Thank you so much for listening. If you do like what you've heard, follow our podcast and don't forget to leave us a review. It helps us make it better and helps other people find the show as well. As always, if you want to join the conversation, you can find us on every social media channel at this stage. Just search for 11FS or Fintech Insider or email us on podcasts@11fs.com. Thank you so much for listening, everybody. Goodbye.